So we'll be moving on to our next panel, which is Constructivism, a prime role for institutions in the digital assets. It's moderated by Vicky Huang, who's an investing correspondent and Business Insider. We have Brandan Maher from Ernst, Matt Hepler, who's from Arca, Quentin Koffey from Politan, and Ray Katzovicz, from Saddle Point Management.
Hello? Oh, okay, great. Hi, everyone. Thank you so much for coming to our star-studded panel. We have what I think is going to be a really interesting discussion. It's truly where TradFi meets crypto. I guess to get the conversation started, we can just go down this direction, introduce ourselves. I'll start. My name is Vicky Huang. I've been covering traditional markets and investing for the past 6-7 years, and I'm really focusing on crypto for the past 2 years. Quentin?
My name's Quentin Koffey. I've started my own firm, Politan Capital Management, but we're a new firm, started about 6 months ago. Prior to that, I worked at some of the larger hedge funds out there that have been very active in activism. So at Elliott Management and at D.E. Shaw were the ones where I spent the most time.
Yeah, Matt Hepler. I'm part of the portfolio team at Arca. Joined last year, and similar to Quentin, worked at several large activist hedge funds, including Relational Investors and Mercado, and led a number of campaigns there.
Brandan Maher, sit within EY's consulting practice, focused on digital assets, support firms with their strategy, implementation, and risk and controls around their digital asset products.
Roy Katzovicz, I have my own firm, Saddle Point Management. Prior to that, I was at Pershing Square. Before that was a governance expert at a law firm around town called Wachtell Lipton.
I think we also have Stephen joining us virtually from the UK.
Hi there. Yeah, my name's Steve Goulden. I am a senior crypto analyst at Cumberland DRW, and largely look after and lead the research effort on our liquid coin portfolio.
Great. So I wanted to start with you, Quentin. You worked at a number of high-profile hedge funds, and you've led a number of very public activist campaigns, which really yielded excellent results for investors. So would you mind kind of highlighting, how activist investing has evolved over the years, and why and how does it create value for investors?
Sure, absolutely. So I think, to start with, it used to be that you have a public company, and if it was operated well and you felt good about the prospects for the business, you would own the stock. And if you were disappointed with management or how things are being run, you do what was called the Wall Street walk, which is that you sold the stock and you moved on. And for a long time, that was really all that was available to people. And I think you started to see increasingly an awareness of there being companies where you had good businesses that were undermanaged. And so people began to come into the space and do hostile takeovers. So they would offer money to buy the company at a premium, try to take over control of the entire business with the investment thesis that once they had control, they could run the business better, fix it, and then maybe take it back public or sell it on to somebody else, down the road. For a while, that was really sort of it. It was like you either had, unless we go all the way back to JP Morgan days and all that. And so really you just had the ability to try to take control or move on. And very few people were in a position where they could do a hostile takeover of a business. Then in the early 90s, essentially, I think we can attribute to that. There was something that was called the short slate rule. And Matt actually worked at the firm of one of the people who put the short slate rule in place. And what that allowed was that you could go and do a campaign at a company, and instead of trying to replace the entire board, you could replace a portion of the board. And I think since then, we've seen over time from the 90s through to today, a steady kind of increase in the professionalism and the receptivity to activism in corporate America. And, it started with sort of more outlandish characters and more outlandish behaviors that I think were effective in bringing attention to bear to situations and played a role. But as shareholders have been more open to activism, more open to meeting with activist investors and hearing their thoughts, more open to voting in support of them, what you've seen is a steady progression where now the nominees that a lot of the activist shareholders put forward to go onto the boards of companies are some of the most well-respected CEOs and operators in that industry segment. And you're putting really tremendously high caliber people onto the board to try to affect change. I've been involved in that where we've had, at Lowe's, we had directors who had been on the board of Home Depot 15 years earlier and helped lead a turnaround, who came into the board of Lowe's and helped to improve that business. I've done it more recently where we've had management team, a CEO and a CFO of very well-known managed care companies who came to a company to help them. But I could go down the line, and Matt and Roy have worked on campaigns like that as well. I mean, I know Roy worked on a campaign where the #1 CEO in rails was brought into a public company to become the new CEO. And I just give some of those as examples because we're talking now not about a rabble-rouser or someone who does something really disruptive or someone who says something funny and insulting in a letter and that letter gets passed around to a lot of people. But instead, now we're talking about some of the best operators in the industry stepping forward and being voted onto the board of these companies by shareholders. And so we see more and more of that. And that doesn't mean that every activist does it, but I think we've increasingly seen this sort of increase in the caliber and quality of people who are involved in activist campaigns. The other thing that we're seeing increasingly is that the activists themselves now, not only are we coming in with some of the best known operators in the space, we have some of the best advisors, some of the best law firms. And so when we're actually sitting down with these public companies, the advisors, the level of research, the diligence we've done, the nominees we're bringing forward to go onto the board of the company are every bit as good, if not better, than what any of these public companies often can do themselves. And I think that's really changed how the large institutional shareholders now increasingly view activism as well. Another trend that we're seeing increasingly is that, like I said, this started way back with kind of hostile takeovers of companies. Then it grew to, okay, I buy a really large stake in this public company and they have to listen to me because I own so much stock, or maybe that was a view. Today, you're seeing people be incredibly influential with owning just a couple % of a company. I've had campaigns where we've had major settlements and we own 2% of the company or 1% of the company. I believe it was last year, the year before at ExxonMobil, there was a shareholder who got directors onto the board and they owned 50 basis points of that company. And what's happening there is not that it's some annoying hedge fund that just is shouting so loudly you got to deal with them. What's happening is that the large institutional shareholders are saying we really support what that shareholder is trying to do, and we're going to vote in support of them. And so it's not that they own so much stock that somebody has to listen to them. It's that they put forward an alternative for shareholders, and shareholders no longer have to only kind of basically do what the company says or sell their stock and go find another company to invest in. Instead, they can say, hey, I like this business, I like this company, but I'd really like it with a different management team, a different set of directors, a different strategic plan that they would articulate. And if you, the company, won't do that, I have an option now. I can vote for you or I can vote for these other people. And that's become incredibly influential. And then I'll stop and let this kind of move on. But as we've sort of seen that progression in activism in corporate America, I think what we've really witnessed is increasingly like we just want to vote. We just want the shareholders to be able to have a chance to vote. And there's one annual meeting a year, and sometimes that board is staggered. And so actually getting to the point where the shareholders can vote on what they want is not always so straightforward. And those are the hurdles that we're sort of spending so much of our time kind of navigating, like actually getting to the point where we can have a shareholder vote on the issue. And one of the things that strikes me as quite interesting about the application of activism to cryptocurrencies is that you can give people an option. You don't need to own the majority or 10%. You just have to have an investment, and then you can put forward something for people to vote on. But it seems to me, and I'll be corrected and learn today, that the mechanics of actually letting people vote, letting people articulate their view, is much more straightforward in crypto than it is in corporate America, where we have had decades of efforts of making it harder and harder for shareholders to actually just carry out the simple action of being able to vote for what they'd like to see happen at a company.
I think that's really interesting, and it highlights this very important aspect of activist investing, which is governance. And so I want to go to you, Roy. Can you tell us why? It seems like a pretty straightforward question, but can you tell us why governance is so important in companies, and how does it link to digital assets?
Appreciate that. And I'll echo a lot of what we just heard from Quentin. So fundamentally, one of the elements that is endemic as an ethos, and to some degree you see it in the actual construction of cryptocurrencies and crypto sponsors, is the whole notion of decentralization, right? The notion that there's some sort of democratization without a central force to enforce norms, laws, or rules, other than the governance mechanisms that have been embedded as a matter of contract in cryptocurrencies and other derivative forms of cryptocurrencies. When you look back in the history of joint enterprises, joint investors coming together, pooling their capital, deploying it for some productive enterprise or any enterprise, productive or otherwise, you look over the last 200 years and it's been a very rough road. And cryptocurrencies, on the one hand, have the flexibility of contract, but they have the hard time of the absence of centralization makes it really tough to get anything done. So what activists do in the equity markets, and to some smaller degree in credit markets, is we solve collective action problems. We buy enough, or we have articulate enough ideas that we can get a lot of people to agree with us, and we have a point of inflection more or less every year in the form of a vote, although actually getting your ideas to that vote, as Quentin said, can be difficult, much more difficult than this in cryptocurrency land. But you realize, of course, everything starts from original sins. And when you look at where and how a lot of cryptocurrencies were developed, and you look at the intuitions regarding those contractual schemes, and you'll see a lot is borrowed from the equity markets, period. So, one issue that Matt and I were talking about, maybe Matt will wax more poetically than I am, but think about in the context of equity markets where you have one share and one vote. That's a typical norm. It's not a rule. It's sort of a rule through some of the stock exchanges, but it's not an actual law. And we know there are plenty of big companies with dual class voting or high-low vote voting, including many from the West Coast, including many that are advised by the very same law firms that create cryptocurrencies. Uh-oh, we got a problem. So what have they done? Well, one of the things Quentin mentioned that there are a number of hurdles, and he mentioned in passing something called a staggered board. You have a board of directors, let's say it's 9 people, they'll split into 3 classes, only one class is elected at every year. That means you have at least 2 years before you can take a majority of the board, right? That's a way to slow someone down. We see obviously in equity markets, dual class voting, something that the many law firms that advise a lot of these tech companies as equities and also sponsors of tokens and cryptocurrencies tried to put forward was something called tenured voting. The idea is an idea in France. It's a bad idea in France. It's a worse idea here. The idea is if you hold the stock, you get more votes over time. Guess what? It's embedded in many, many cryptocurrencies. And why should it be that a person holds, we'll call it $1 worth, but whatever denomination you want, of a cryptocurrency, but has held it for a long time, should have more vote than someone else who has $1 of the same currency? Doesn't make any sense. It's really only one reason for it. It's a way for the founders or the sponsors to maintain control. Now, that's not all bad in the sense that if there are bad actors in the system, if you have a virtuous founder or virtuous anchors, maybe they act as some kind of stabilizing force. And no doubt that's how it was pitched when they first launched. But as time goes on and currencies change hands and ownership of any fractional asset changes hands, incentives start to change too. And giving up that control blocking position is something people are very loath to do. So for me, as it relates to governance, and I look at cryptocurrencies broadly and decentralized finance schemes, I see great promise in so many ways, particularly in reduction of transaction costs, which is the friction that kills the world, right? The entropic forces of the universes are no more present than they are in transaction costs. And so much of the beauty of cryptocurrencies and the thought behind them is that those can be reduced, if not eliminated entirely, with tremendous amount of rich information developed along the way. I look forward to seeing what comes out of the current sense of disruption, just mostly with market prices, because it's really through the crucible, through hard times and getting burnt, that you get stronger. And that when people have conflicts and they're resolved, and we have new rules that come out of those resolutions, whether they come from courts or they come from collective action from users. So what's interesting about cryptocurrency is that or crypto land is that it's so nascent in the establishment of the rules and the norms that will govern how these things trade and what they're worth on a long-term basis. But that means there's a lot of promise. At the same time, you must understand that the people who put these things together have a lot of learned wisdom that many owners of these assets haven't yet been exposed to, particularly around how governance works. And those will start to matter in extremis. Baseline rules, norms, and governance mechanisms don't matter if the value of an asset continues to go up and to the right. No one cares. When that changes, it starts to matter a lot. And I think that's going to happen in this market as well.
Great. Now that we've heard from two, veteran activist investors in the traditional finance space, let's go to Steve. When you are analyzing crypto projects, and you used to work in traditional finance as well, how do you think about, applying some of the disciplines in traditional activist investing to digital assets?
Yeah, sure. So, I mean, if we look at crypto businesses, so far, obviously there's a spectrum of centralization. Obviously we've gone from the sort of decentralized, in some cases, quite anarchic, to more centralized and basically founder-led, right? And obviously, I think it's fair to say that the sort of early DeFi projects are probably more in the former, and L1s are more in the latter for obvious reasons. Clearly purely decentralized business models have a number of limitations. Firstly, it's very slow making decisions, especially when things have to go to a governance vote. Clearly, if it's truly decentralized, then you could argue protocols are probably sort of limited in their ability to come up with new products and therefore offer, more than one or a very small number of product offerings. And I think the lack of centralization just means it's difficult to drive the business forward, especially as this often requires, as in an established company in the traditional world, strategically focused leadership and people in the business with relevant product and business development experience. The other thing as well is that it can be difficult for these businesses to react to competitive threats, which is clearly I'd say almost a bigger problem in crypto than in TradFi, because things move incredibly fast, and moats and sustainable competitive advantage are very fleeting, I think it's fair to say, certainly so far. So I think in reality, most of these crypto businesses are sort of somewhere in the middle of that centralization spectrum, but are still usually founder-led to some degree anyway. And in that case, a lot of these founders might not have extensive management experience or have run startups before. Regardless of the level of centralization, I think that might also find that the tokenomics and the protocol design might have been conceived fairly early on in the life of the projects, and now might not be appropriate. It could be liquidity incentives, it could be a number of things basically. But so essentially, from a number of angles, we think there's a big opportunity for a role for almost like an external advisor to kind of come in and advise management, or even construct proposals for the community to vote on. And we think that long-term investors can kind of fulfill that role, certainly for now, kind of like a VC might do in an early stage or in the Web 2 space, or to some extent like large shareholders might do in the listed equities world. And this could be across, say, hiring, it could be across, communications and PR, or essentially investor relations, which, it frankly is pretty nascent or non-existent really in the crypto world to some degree. Or things like, treasury management, how to manage whether or not to put a portion of the treasury in ETH or stable coins, those sort of things. And I think these investors as well, clearly have a large network that can be tapped into, which is obviously useful for things like senior hiring, that kind of thing. And I think going back to a point that was made earlier, while activist shareholders can obviously be quite adversarial in the listed equity space, it doesn't necessarily need to be the case in crypto, and it can often be, as Matt was saying, for the point of this debate, constructivist, and more kind of helpful and softer to a large extent. And I think we have found that our input, and the input of other large investors is generally well received. I think it's generally quite rare that management are as against token holder friendly initiatives as maybe they are sometimes in the equities world. The other thing is obviously, given that up to this point, crypto investors, I'd say it's fair to say, have a shorter term time horizon than equities. Having these long-term oriented investors is generally pretty welcome, and I think gives the token probably some stability. I think the other thing that's worth mentioning is just governance participation. So, most crypto protocols tend to have a fairly low degree of participation. Generally lower than about 10% of circulating tokens on most votes. And this compares to about 80 to 90% on equities. So, thinking about that, assuming that ownership isn't too heavily centralized amongst the founders or maybe, VCs, that gives large token holders a really significant voice in crypto, more so than in equities. And often these votes can be, proposals can be determined by a handful of large holders. So it's easier to have, a pretty constructive voice in the token world than it is in the crypto world than it is in equities. I guess last kind of point I want to make, as we move forward, I think that most crypto platforms will kind of tend toward a greater degree of centralization. I think particularly as we see more sort of Web3 protocols coming through, and by that I mean sort of real world utility, essentially almost like tech stocks on crypto rails, coming through into the crypto space. And yeah, as I say, I think these will come to look more like the tech stocks, platform businesses, whatever you want to call them, that we know very well from the kind of listed tech space. And I think that will sort of, the way that will evolve is that you will have some functions that will be done on a decentralized basis. So, be that sort of peer-to-peer infrastructure or liquidity provision, or even labor. And a good example of this would be Brain Trust, which is a platform that we invest in. And this is essentially a recruitment platform for high-end IT workers. And the platform basically issues tokens to third parties for vetting potential candidates and also referring clients, which obviously bootstraps a network and improves the quality of the talent base and ultimately speeds up the hiring cycle. So it's a similar-ish platform business to what we've known before, but has a reason to exist in crypto. And I kind of see that as the kind of thing that we will evolve into going forward. But critically, there would be a very experienced layer of management above that from a strategy perspective, a day-to-day management, BD, product development, etc., probably beyond what we've seen in the first wave of crypto projects. And I think if these crypto businesses are going to compete effectively with Web2 incumbents, that you're going to need that. You're going to need that degree of maturity and professionalization that I think we're starting to see now. And I guess just to finish off, I think the implication of all this for activist token holders is that, as these crypto businesses mature, and possibly centralized to a greater degree. I think there's more of a role for experienced kind of benign activist investors to help them with that progression.
Thank you for sharing that example and the opportunities that investors in the crypto space can help businesses mature. And I think you raised a really good point about how few token holders are actually voting in these proposals these days. And that's the point that Matt, we actually also talked about backstage. It kind of also shows how early we still are in this sort of activist investing in digital assets. Can you share your views on that?
Yeah, and I've had the privilege to be on both sides now in equities and digital assets, and we're definitely in the early innings in digital assets. But I think it's a very exciting time, because if you think about how these businesses are constructed, you don't have a board of directors, you don't have a C-suite of executives, you don't have consultants, and there was really not much to govern 5 years ago in digital assets. You had Bitcoin, Ethereum, and a handful of other coins, but now you have real businesses that are generating revenues, earnings. You know, there's billions of dollars of treasury that need to be allocated, and in many cases, a lot of these businesses were formed by really brilliant tech folks and developers. And I think there's a really positive opportunity to merge some disciplines and insights from traditional finance to digital assets. I think, why is governance and sustainability important? We call it GSE instead of ESG. If you look at performance, the best governed stocks in the NASDAQ on sustainability and governance outperform the market. It's a limited history with digital assets, but we've seen in certain cases that we've worked on, people are starving for governance improvements, tokenomic improvements, and that's reflected in prices. So we think a lot of the same concepts, can be applied to digital assets. The rules of the game are definitely different. I mean, part of the beauty of digital assets is that they're decentralized, so you don't have to wait for an annual meeting. You're not required to own a certain amount of tokens. It's really about galvanizing investors and community members. You're talking to all stakeholders, not just investors. You're talking to employees, developers, people that hold tokens, that don't hold tokens. And you're trying to galvanize people around a common voice that's going to create value for the business and sustainability. Now, part of that process right now is very difficult because there's not really a cadence of voting. There's tons of proposals. It's very difficult for individuals to figure out what proposals are valid and which aren't, or which are actually going to really create true underlying value. It's amazing. The voting turnout for digital assets right now is between 5 to 15% on most proposals, and those are the ones that are good. In equities, it's usually over 80%, because you've got BlackRock and State Street and Fidelity, and everybody has governance infrastructure to actually vote their shares. And I think one of our initiatives is to really increase voter participation through educating people that their vote really matters, and changes to tokenomics, changes to treasury management, treasury diversification, compensation structures, oversight, governance structures. So there's a lot of ways that I think thoughtful, credible investors can actually really help in this industry. And we've, as a team, we've got a lot of resources. We are not, coders ourselves, but we have a great network of consultants and folks like Ernst that have, hundreds of developers that can help us validate changes that we're suggesting. So I think the future is very bright for collaboration between investors and digital asset businesses. It's probably a good segue to you, Brendan.
Yeah, I know that, there's some news out of Ernst & Young just recently about the efforts in that direction. So Brandan, if you however, whatever you can share, can you sort of talk about the role of a consultant in the digital asset space? How do firms like Ernst & Young, what are you doing to sort of advise or strategize and help firms in the space conduct active investing?
Sure, happy to share some thoughts on that. I think maybe for starters, just to set some context in terms of UI's role in the broader digital asset ecosystem, I think maybe just talk a little bit around what we do. Many folks might just see us as a big four accounting firm, but we really work across our entire business, across all four service lines. So obviously we do conduct audits of cryptocurrency holdings. We've had firms that have held Bitcoin going back 10 years, and we ultimately need to understand what the impacts of that looks like on firms' financial statements, and ultimately whether we can rely on on-chain evidence. So we stand up nodes, we buy assets to ultimately understand how that works, and we see if we can break controls outlined in white papers. We do taxes for firms that have cryptocurrency holdings. Just this last year, we had one client that had 7,500 wallets, 500,000 transactions across 60 protocols, over a dozen transaction types, and so we built up software capabilities to support those types of reviews and tax filings. We've got engineering capabilities. So some of the recent announcements, we had an announcement last week around blockchain analyzer. We've made that available for non-audit clients from a general public standpoint. So that's available on our website. And just yesterday, we had an announcement around Ops Chain, which we built on Polygon Nightfall. So that was just a press release around that yesterday. So deep engineering capabilities. We help firms with strategy. We also help with risk and operational consulting. And that could be things like token due diligence for exchanges that are listing 100 new tokens, in a given cycle. So I say all that just as a backdrop in terms of the type of work we do. It's broad, it's multidisciplinary. And I think the thing that we really bring to the table in this space is that multidisciplinary approach, an end-to-end framework of looking at risk and how does that inform your strategy as an investor or investment firm. So the way we look at that is through a few different lenses. So I think there's first aspect of that is technical. So what's the technological operations of a given token or protocol? What are some of the cyber components that need to be considered? For any proposals that are being put forth, what's the technical feasibility of that proposal? Second dimension is financial. So that's taking a look at tokenomics. And if a governance proposal is ultimately looking to propose changes to that, that would certainly be an angle that we could be looking at. A third aspect is going to be kind of legal, regulatory, and reputational. That looks at things like Howey tests, but ultimately reputational can span pretty broadly. And then the last piece is people. So who are the founders? What does the community look like? What does the token holder composition look like? So we really kind of bring that multidisciplinary approach as we look at risk across the digital asset ecosystem, how that translates to the specific topic at play here. So let's say you're an investor and you're thinking about putting forth a given proposal, and maybe you don't necessarily have the technological depth on some of the technical feasibility components. We could consult with you on that, take a look at what you're proposing, take a look at what the current state is, and ultimately provide some kind of review, feedback, and recommendations on a path forward. So that's more on where an individual firm actually taking actions. The second side of it, though, is for somebody that's holding liquid tokens, you need to understand what's being put forth either from a governance proposal or just from an on-chain activity standpoint. So certainly support firms with kind of ongoing risk management. That could be looking at proposals that are being put forth by others. What are the potential impacts of that? We also do on-chain monitoring, security type audits as well. So that all kind of bundles into the same overall framework. So overall, we think professional services firms, there's a kind of merit and value of that type of a role within an ecosystem for a few different reasons. It could be technical expertise just on a given dimension, maybe that a firm might not be as deep on. Scale can be another component to the extent you've got a broad portfolio. Ultimately, there's a lot going on and being able to monitor across a variety of different dimensions. And then the last piece is, and I think, important as we look at kind of overall market conditions in recent weeks, is kind of a second layer of defense is, what are things that are happening that I might need to be considering, recognizing that investors and investment firms are ultimately in the business of risk management. This can be kind of a complementary aspect within the toolshed.
Great. So it seems like we have some extra time left. So maybe before we go to Q&A, we can go around and maybe the panelists can share some of your thoughts about, what are some of the disciplines or strategies in traditional activist investing that can be applied to digital assets.
I mean, a lot of it is getting your idea out and having quality analysis. Usually, if you present things that are fact-based respectfully, and you do put a lot of work into them, and you can prove the value creation or improvement to the business, you typically get a good response. And with in digital assets, you have to do that with forums and using Discord and a lot of different things that you're not used to in the equities world. You can't just put up a PowerPoint presentation, post it, publicly on a news release. You actually have to be engaged with the community. The nice thing about it is you're getting real-time feedback, so you can actually iterate, as you incorporate people's feedback. But I think the main thing is getting your message out. People use Twitter, they use Discord, things that people in traditional finance are usually not even allowed to use in terms of social media. But yeah, I think it's really communication and engaging and having good analysis that can be verified by, people that have a very good expertise in tech.
Yeah, definitely can imagine Carl Icahn or Bill Ackman using Discord to conduct activist investing. Steve, do you have any thoughts on that?
Yeah, no, I'd echo what Matt said. I guess just some other kind of thoughts on it. I think it's more effective if kind of along the lines of spending time on Discourse and whatnot, but not just with the community, but with the founders and the management, building that relationship, kind of building that trust. And I think particularly where, you're dealing with somebody who's maybe not used to dealing with the Carl Icahns of the world, for example, right? And so coming in with constructive, helpful, recommendations, also kind of adding value in terms of thinking about things from a very kind of finance heavy lens, and sort of interpreting that around tokenomics and whatnot. Sometimes, particularly if the management team come from a software developer background, a lot of that can be new and maybe sort of to some extent kind of intimidating. So I think, building that relationship, but also thinking about ways that you can kind of add value from a TradFi skill set that a lot of these people might not necessarily be that familiar with.
Great. And I'm also just curious, are there any successful examples of, activist investing in the crypto space that led to token appreciation or just helping the business mature to an extent that it wouldn't have otherwise?
Yeah, I think you can look at a number of different examples. I mean, there's Yearn Wi-Fi went through a big tokenomics revamp. We were involved in Gnosis, which was a big balance sheet kind of capital efficiency story, and they ultimately created a DAO and that was backed by ETH and have had tremendous success. We're currently invested in Sushi. They just announced a big transformational turnaround plan. So yeah, I think there's evidence of success. But yeah, I mean, I agree with Steve. I think, to the extent that you can build relationships and you're not just shouting, on Twitter. And same thing in equities. If you can actually show that you're here to fundamentally create value for everybody, and that it can be on a variety of things. It can be on, you said compensation design or rewards or tokenomics, and it can be a lot more collaborative. It's not as brazen as people think it is. And we want the best thing. We would never try to propose something that wasn't in the best interest of the business, because ultimately that destroys value and doesn't create it. So here's Steve.
Some of the other activities or tactics that activists use will rear their heads here, right? Almost certainly. So litigation is coming. You don't see this degree of disruption and stablecoins coming untethered without there being sufficient and significant litigation coming afterward. And while that's terrible to experience in the moment on all sides, it does give a certain kind of clarity and gives you a sense of what baseline rules are and sets new norms. So to the extent there are longer term holders who, feel that things were said and done that they relied on that turned out not to be true, we're going to find new law or the application of old laws coming to the space fairly quickly. I'd be surprised if stable coins that are finding a lot of turbulence right now and have broken the buck aren't already under massive investigation for a number of different government entities. And you won't be surprised in the context of equities, a lot of those government agencies get their best material from holders. The same will be true in crypto. It's undoubtedly the case. So we'll see a lot of that. Vicky, you're part of the solution, right? You're moving from Business Insider to Wall Street Journal. Part of the press and the maturation of the press in more sophisticated and bigger distributed channels also helps set norms. And so, Vicky, I guarantee that all the activists in this panel will be calling you to help them with their activist campaigns in connection with cryptocurrency land, to the extent they have it, because who wouldn't want to work with the Wall Street Journal, right? So we see, so the press will come in deeper ways. And it's not going to be the vaunting, look at the decabillionaires press. It's going to be the shrewd-eyed, a little bit skeptical, that press is coming. And where I think we have the greatest potential and also the greatest setback really comes to how do the mechanisms of vote and change actually apply over time in cryptocurrency land. Is the fact that you can submit anything as a protocol or new change to a protocol to everyone at any time and all the time, is that really good? I think it's better than doing it once a year, but is it really good? Is it really going to be efficient? So we're going to see what we basically do as activists. We see a gap in value and we look to solve the collective action problem by collecting a lot of people to vote in the same direction. So how are we going to take advantage of that? Are we going to do that well or not? So these are some of the emerging issues I think we'll see from a crossover tactics perspective.
Great. Thank you for that insight, Roy. Now that we have 5 minutes left, we can go to Q&A and see if any of our audiences has questions for the panelists. Okay, great. Well, they will be around for a little bit. So if you have any questions in private for them, you can just find them at the conference. Thank you, everyone.
Thank you.